Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. We're back once again to continue to help to educate you so that you feel much more comfortable as well as confident investing beyond your backyard. I'm your host, Billy Keels. And you know what? If you've ever wanted to know how to go to creating the trifecta to finding life-changing capital after leaving Wall Street, then guess what? Today's conversation is the one that you're going to want to listen to until the very last word, because today's guest not only spent 13 years in Wall Street, he also, on one of his very last Wall Street gigs, he advised senior oil and gas executives on price risk management solutions, which is really, really awesome. Hopefully he's going to tell us a little bit more about that as well. And today he's focused on buying underperforming multifamily properties as well as partnering with good people. And you know what? He found freedom by focusing on 3 strategies to build his portfolio. And it gives me great pleasure to welcome today to today's show, the president of Life Changing Capital, Ryan Christopher Nunes. Ryan, welcome to the show, man.
Billy, thanks so much for having me on. I appreciate it.
Yeah, man, it's really looking forward to today's conversation. I love your long distance story and also the things that you are doing. But as you know, we like to ask everybody the same 5 questions. And then in between, we're going to get to know you a bit more and understand what exactly you're doing so that the entire Going Long family can get to know you more. But I guess we should probably get started with the first question. So help us understand, where exactly are you located in the United States?
I'm in Houston, Texas.
All right. Houston, Texas. I used to live there, by the way. So everybody in the Going Long family, if you didn't know that, now you do. Lived in a place called Missouri City, Texas. So that was many, many years ago in the late 70s, mid 80s to mid 80s. So awesome. Listen, also to Brian, help us understand, what is the most positive thing that's happened to you in the last 24 hours?
We're deep into a transaction. So that's pretty exciting. That's gotten our full attention.
Awesome. We always love to be able to hear that because it's positively impacting other lives, and that's going to be really, really awesome. So listen, at a very high level, I shared a little bit about your story, Ryan. So I'd love for you to share with the Going Long family. Give us a bit more about your background and also maybe some of the major decisions that you made up to this point in your journey, and then we'll get to know you even a bit more.
Sounds good. Thanks, Billy. So I grew up in New Jersey, outside of Princeton, New Jersey, did my undergrad at Georgetown University in finance and international business, and then did my MBA at NYU. Nights and weekends while I was there, I started rubbing shoulders with some folks that were working on Wall Street and really decided with an undergrad and an MBA in finance that Wall Street was the right place for me, and took a job in commodity derivative sales. And it was, the best way I describe it is what happened with the internet revolution was going on in the oil and gas space with shale revolution. A tremendous amount of supply growth, a tremendous amount of demand as we were, growing in the country and worldwide economically. And, there was just a heavy need for risk management solutions, i.e. people that were going to put $1 billion into the ground to drill and wanted to lock in their price of oil or gas. And so I helped a number of CEOs, CFOs, treasurers, and other corporate employees with their risk management solutions while working at different Wall Street banks. I did that for 13 years, had a very successful run, was promoted to managing director, one of the youngest at the firm. Ran a team of sales professionals for the Americas and called on producers, airlines, cruise lines, power plants, and we had a portfolio of some 300 or so clients. So it was quite interesting, quite exciting, very fast paced. And, just given the ups and downs of commodities and, just also the sustainability questions about the future and the transition to renewables, I, for a number of years said, what else could I do? And just in case the train does stop one day, and had looked at a lot of different things. I looked at franchises, had looked at starting restaurants, music schools, early childhood education centers, and just have a lot of interest and passion. And kind of chance circumstance was at a Chuck E. Cheese for those of you that live in the U.S. I don't know if that's an international brand, but looking at Billy Smile, I think that he might remember that from his childhood. But was there for a child's birthday party, and one of the fathers was telling me about multifamily and how he transitioned to it, and I was just blown away. And the tax benefits were just incredible. And I decided that this is what I need to do, and I need to do it right away for, one, because this had met a lot of the goals that I was striving for, namely, and what's something that would have a long-term trajectory and sustainability, something where I could apprentice my children, and then something where I could impact people. So those three things. And when I heard about the tax benefits, so for every dollar I invested in the space, I got back roughly an 83-cent non-cash paper loss, so purely on depreciation. So huge tax benefit. End up getting over a $200,000 refund from the IRS, which I deployed into 2 deals that we closed in Q4 of last year. So my business partner I met, who is also ex-Wall Street, private equity, just have had a great working relationship over the past 2 years. And so we've been, pretty active in the space and take a very differentiated approach to the asset class, very institutional. And, typically when you're looking at the sub $30 million space, it's, for lack of better words, it's, folks that might have come from an IT background or, some mom and pop players, but we really try to take a very professional, just borrowing from our backgrounds, very institutional approach, very transparent as well. We take the fact that we're investing other people's money very, very seriously. Frankly, it keeps me up at night. And so, we always invest, tend to be some of the largest investors in our own deals, just because we believe in them. And also we want to show that we're committed to the projects. And then very hands-on. So I'll go to our properties. We closed the property in San Antonio in Q4, and I've spent, 2 days, multiple times at the property, putting on my work clothes and working alongside the maintenance staff, to just show solidarity and to show that, I understand what they're going through, and it just builds great camaraderie. And so that's something that we do that's different, to really truly understand the operations. And, it's not just about numbers for us. It's also more about collecting rent, but also about, running the properties efficiently and keeping staff engaged so that we can do a better job for our investors. So that's kind of our approach and so forth. In a nutshell, we focus on the Texas Triangle and buying B and C class properties. Tend to see a lot of off-market deals and very strong relationships with brokers, and just we have very quick response time. Going back to the institutional background, any deal that's given to us will respond from a partner, from a broker, 24 hours, full feedback on and quick feedback on, is this something we're going to pursue or not?
Wow. So I love that, man. There's a lot of different things we can unpack there, but I guess I want to go back to Chuck E. Cheese. And it is amazing what can happen when you have a major tax issue, right? And you're having a conversation with someone who's in the multifamily space while you're at Chuck E. Cheese. I think that's where it all began. Yeah, I think that is, I think it's absolutely fantastic. So you talked about a couple things as well, and it's bringing this, the Wall Street background. So, I mean, you made a big decision, right, to leave a Wall Street firm to be able to leave Wall Street. Let me put it that way. And so when you did that, maybe take us through some of what the reason was, aside from you had 200,000 kind of reasons that helped you move into the space even more so. But I mean, a lot of people, the kind of like where you want to end up is Wall Street. And so maybe take us along that journey. What was it about what you were doing at Wall Street that made you realize, well, hang on a second, I want to maybe move over to this other real asset space?
Yeah, for sure. Having been in a space, I think Wall Street is very good at paying you for what you're specialized in, and that they want specialists. They don't want, generic people. And so for me, I was becoming more and more pigeonholed as a commodities person. And, the other thing about Wall Street, it's like professional sports. You're paid extremely well, but you never know when you're going to get traded. and trades happen often, and firms, tend to pile into a space and then realize, maybe that wasn't the best decision. And react quickly. And so there was, 3 different organizations that, went into commodities in a big way and then pulled out, and the next one would go in. And each time you're getting paid more and more, but that it's like a signing bonus, and you never know when the next one's going to come. And so you take the train as far as it will go. And then you realize, hey, along the ride, hey, this is awesome. But, I think the moment of truth came for me when I was sitting down with another colleague in the space, and we both have small kids. And we said, wow, by the time our kids graduate college, our field is going to be A, completely different, and B, may not exist in the same form or fashion. And for me, that was humbling because, I think a lot about, in some ways I'm pretty old school. So I think a lot about what was it, I guess before, when people lived and apprenticed their children and taught them skills alongside of them. And, for me, that was just important. And I wanted to be able to have my kids see and understand what I did. And also as they're learning, have an apprenticeship so that they could step into that field one day. So, what that means is, my kids, we both visit our properties, or all together we visit our properties. And my daughter, who's 11, has actually helped me with a lot of Facebook and different marketing. And, she's very capable and talented. So, it's just a great way. And I'll explain the business to her, and I'll explain the cost of rehabs and the rent bumps and the return on investment, and, why we're doing what we're doing. And I think just that tangible, it's in a way, it's an easy to understand business. You're buying a community, you're investing in that community, and you're turning units, making them a nicer and a better place to live, and hopefully enjoying the fruits of that labor through increased income and resident satisfaction. So, the apartment business is just not going away. Like any business, things could change, whether tax legislation or interest rates or so forth. But fundamentally, I think that it's going to be, the U.S. continues to be a nation of renters, and I think that doesn't really change. So I think fundamentally it's just a great spot to build a future and a legacy for my kids.
So, and it's interesting when we talk about these things, how legacy can really come into play when we get to a certain point in our life. I read a book by a guy named Bob Buford, and he talks about halftime. And so sometimes there's a point in your life where you see certain things and you realize, and it sounds like you went through that as well, like you can't really provide your job to your kids. And so you saw an opportunity to really get to have them also be a part of something that you're doing. So with one of the exits would be to have your children also be a part of your business. Would that sound accurate?
Yes.
Okay. All right. Yeah, it's interesting. Also, to you, I want to talk a little bit about the background, not just Wall Street, but also energy, right? Because the energy sector, and I think that a lot of times when we start talking about real estate, we get really into the real estate, and we sometimes can lose sight of the macro picture, right? And so I'm just curious as to, having had that background in the energy sector and recognizing that pretty much everything in the world is related to energy because you've got to move something from point A to point B. Like, how is that really playing a role in some of the different decisions that you're making today, or even the way that you're viewing the multifamily space?
Yeah, it's, because, and it's hard to change this perspective, is, 13 years doing commodities, derivatives, everything in real estate is always like, oh, I've seen this before. This is what it looked like. It's like a translation, like speaking a foreign language, and I constantly just translate back to what I know. And I think that's a differentiated thing that we provide. But, places like, the Texas Triangle, where, energy demand has been increasing, and where supply, the kind of supply engines of the oil and gas growth were focused in Texas. And so, hence that translated into people needing office space and apartments and places to live, and, higher incomes. And so Texas was a huge beneficiary. So, the energy industry and real estate can be very interrelated, from a global perspective as well. And, energy is probably one of the most macro, commodities as well as interest rates. So, those two things are just, as oil and gas demand go up, it's going up for a reason. People are, consuming more electricity. They're buying TVs, they're using the internet, they're driving cars, they're flying on planes. And all of that just means, global growth, and global growth translates into, people want, nicer apartments and so forth, can afford to pay for more luxury in their lives. So, those are just a huge intertwining. And I think what's so interesting is there's, frankly, I have had, just blinders on for commodities because, I was paid to do that well and be singularly focused. And, it's exciting for me to see that real estate does have a lot of interplay. And there's a lot of things that I've just borrowed from my commodities background to apply to commercial real estate.
Which I think is fantastic. So, and being able to apply a lot of those lessons. So you use the commodities and you're applying those to real estate. And I'm just curious because I would love for you to. I like the energy space as well. So, and some of the things that you were doing before when you were helping advise on pricing, probably locking in certain prices for a long period of time, maybe, and you can help how this relates directly to maybe what you were doing before to interest rates, because also interest rates are really important in the multifamily space or anyone who's going to use debt. So maybe help to tie that together, how you can see what you're doing in your previous role is also serving you today, using that price on energy as well as maybe interest rates.
Sure. I think the biggest thing that I learned in my career, having lived through the global financial crisis and obviously the pandemic and, a various boom and bust of energy, 2015, 16, oil went from, 110 to, whatever it was, $25 or so. So, living through those moments and understanding that markets are cyclical. And, when we had the crash from the COVID crash, and, one thing I learned, I would say in the financial crisis when I was on Wall Street, and a number of banks were on TV saying, "Hey, we're okay," and the next day they were, declaring bankruptcy or folding. And that was tough. But living through that, and then seeing though a number of those banks emerging stronger, and companies emerging stronger from that. And what it taught me was that you have to just, stick through things. One, things are cyclical, so things will go up and things will go down. That is, just fundamentally what's played out in history. And I think, very similarly, with oil and gas, when things crashed and oil went to minus 37, I started buying, different oil and gas stocks because I was like, there's no way the world can survive if they're not consuming oil and gas. So, things where there can be panic is opportunity. And, similarly with commercial real estate, and, people thought that, the multifamily thesis was going to be, train wrecked. And, there was a joke of people saying, COVID discount became a COVID premium because cap rates only compressed. The space proved itself. And I think there's been this rotation out of office and retail into multifamily. So much more demand. So places in Houston, for instance, I would say, on average, they were getting 10 offers, pre-pandemic on a listed transaction, another 30 plus 40. And so it's become where DFW was, a year or two ago. And it's just, getting extremely hot. And it's not baseless. It's because the sector has proved itself, and that it's been, high occupancy, I would say, quote unquote, lower risk play that yields cash flow. So, that cyclicality of markets is probably the thing that, you feel like vomiting, and frankly, seeing my equity portfolio lose whatever was a third of its value, when the kids would be like, "Hey, what's wrong?" It was tough. And I would explain to them, this is what happened, but I didn't sell one thing. Frankly, I bought more. So, and that's just because I've been there, I've seen it through, and, I knew that, a lot of things in markets, people overreact, and you have to stay the course. And that's something where it's not only a good life lesson, but it's market lesson. It's a real estate lesson. As it pertains to interest rates, interest rates are, an indicator of, the global health of the economy. Obviously there's been, going from 50 basis points in kind of the summer of last year to 170-ish or so now as a big move up. But you look at its two sides of the equation, is like, why has it moved up? And it's frankly because, people feel like the worst is behind us. The vaccination rollout has been strong. And, for anybody that lives in Houston, traffic has never been worse, at least for me. And not everyone is back to work yet. So I think it's just been a huge migration to Houston, and just anecdotally. And so, interest rates are going to hit a level that is higher than where they were when we were in the depths of despair.
Yeah, interesting. So I love that you draw that parallel, and you can help us kind of understand some of that. And one of the things you said before is, people are always going to need a place to sleep, and when that is one of the parts of your equation, it usually means that you're always going to have someone that is going to need the service that you are in fact producing. So just really quickly, right? Because one of the things we love to talk about here on the Going Long podcast is really being able to invest beyond your backyard. Now, one of the things that I happen to know about you as well, and I talked about this a little bit before, was that you've kind of used 3 different strategies to continue to build out your portfolio and to be able to serve yourself as well as your investors. And this is what I mean. So I know that you have also you've gone from passive to co-sponsoring to being lead sponsor, right? So those are the 3 strategies. And you've done that across 5 states and almost 3,000 units in the combined portfolio, and those 3 different strategies to be able to use. But maybe you could talk to us a little bit about also investing beyond your backyard. Is probably more when you were doing the passive stuff, but just to help us understand, because one of the things that really want to break down is you can invest beyond your backyard. You don't necessarily need to live in the same location. I mean, I've been living in Spain for the last part of 15 years and exclusively invest back in the United States. But maybe talk to us a little bit about that whole thought of investing beyond your backyard as a passive investor, some of the things that you were looking for that made it okay for you to say, okay, well, I live in one place, but I'm okay with placing my capital in a particular opportunity that is thousands of miles away.
Sure. And I think this is a great question. And I think it, for me, kind of touching a little bit upon what I learned on Wall Street is that for my personal portfolio, I like to be diversified. So, diversification across equities, diversification across multifamily. And so from a limited partner, a passive perspective, my goal was to diversify across sponsors, across markets, learn different markets. And the markets that I invested in were at some point in time markets that I said, hey, maybe instead of, jumping in and lead sponsoring in that area, maybe I just test the water, invest passively. I needed to invest passively for tax purposes, in terms of getting depreciation. So it was a great opportunity for me to learn from different sponsors, to learn the things that I wanted to emulate and the things that I definitely wanted to do differently, as well as learn more about markets and so forth. So, I think there's a huge advantage for folks that are passive is really diversification across your portfolio. And this is a very inefficient asset class. And so, one property, in one location could be performing very differently than another property just a block away. So from that perspective, it's really helpful to diversify and make sure that you can learn from different sponsors and make sure that who you're investing in is someone that I like to say purposefully passive, that like and trust them, but why are you investing with them? Is there something that okay, from a returns perspective, but do you also want to learn something from them? Is that someone you can learn from, and so forth? So those are kind of the factors that went into my decision making. One thing that would be helpful for your listeners is people that are thinking about, hey, whether I'm new to investing or, hey, I just want to see how someone that, like myself that worked on Wall Street thinks about investing passively. I put together 25 questions every passive investor should ask. It's on my website, lifechangingcapital.com. But it's a free resource, no strings attached. Just something that, for me, I had so many questions and frankly didn't know where to start when I was investing in, 15 or 16 or so deals that I invested in passively. And so it's just, I felt like this would help people. So if that's something that's valuable for your listeners, Billy.
Yeah, fantastic. And one of the things we will definitely, I'm going to recommend everybody go to your website. I mean, I've been there. It's been fantastic. And those 25 questions is definitely someone who, especially when you're looking at the passive part of things, they can draw from your experience and also get a chance to know you more and know more about what it is that you're doing. So, and so I want to take us through that kind of like evolution, right? Because we're talking about passive investing and being able to do that across different locations. And one of the things that you hit on, and sometimes people would say, is real estate really an asset class, just because of the fact that, and you gave a perfect example of, well, typically an asset is, or an asset class, if you're looking at a specific commodity, it's the same price all around the world at the same time. With real estate, it's just as you described. I mean, there are multifamily buildings, but if you go one block away, it could be completely different. And so because of those inefficiencies, when we're able to understand where those inefficiencies are in a marketplace, we're able to positively exploit those, right? And be able to create positive impact and returns for our investors, and I love that you talked about that. So just going through the evolution then, right? Because where you are now, you have a very clear focus, but you've also gone from passive investor to co-sponsor to now lead sponsor. So maybe talk to us a little bit more about the different dynamics and the triangle, and kind of why you've decided to really focus your energy and your company's time there to help investors understand some of the different opportunities that exist within the triangle.
Yeah, for sure. I mean, for me, just given the background that I've had and the business and financial experience, and also, this was a full-time career for me. So it was hard to, justify stepping away from Wall Street to just passively invest. And frankly, I just really enjoyed the business so much that I wanted to get my hands super dirty and, really manage assets and manage people, and just very similar to what I've done. Again, just a different underlying, and not commodity derivatives, but commercial real estate. And so, from the co-sponsoring perspective, that was a stepping stone to just say, hey, I'm partnering with guys that have 5 years of experience. Let me just learn everything I can from them, and be on their weekly calls. We had twice a week calls on one asset, weekly calls on the other, and did that for a year. And, frankly, a month into it, I realized they came from different backgrounds. They didn't have the Wall Street background. And I just said, I want to apply Wall Street deep analytics and, deep business skills to this versus, what other people apply from real estate. That's how I want to run businesses. So, that was kind of a fork in the road for me, where I said, well, if I want to do that, I need to partner with someone that has a similar and has been through that boot camp, if you will, and knows, that application of Wall Street principles, which I've written about too. That may be something that's helpful, because you've asked a lot of good questions about the parallels between commodity derivatives or Wall Street and multifamily. And so, then it just became, well, how can we apply these principles and, lead deals and run things differently? And I think, in a way, we've thrown a lot of things out the window that, typically are done in commercial real estate. And we just say, that's great, but we feel it should be done this way, like a higher level or higher order, and hold people more responsible and accountable. Is, frankly, what I've seen in commercial real estate, in the B and C space, is kind of what people see for the general contractor, who's, it's over budget and it's late. And, for me, that's just not acceptable. So it's holding people accountable. When you said that you're going to deliver something, where is it? And, just, it's, can be awkward conversations, but it's like, you only have a few of those until they, start changing their behavior. And so that's really what we're looking for. And we're holding our partners and other service providers accountable.
And being able to hold people accountable, hold companies accountable, and be able to have that open conversation is something that, once again, it helps the individuals that you are teaming with to understand the standard to which you're holding your operations, right? Because that's a very similar thing that you're going to also be expected to deliver for your investors, which I think is very it's fantastic, because I'm completely aligned with what you're talking about. So, one of the things that you have 4 key principles that have helped to make you successful, and I'd be really curious for you to share with the Going Long family as you've gone through this evolution yourself, and now you're being able to derive value from the front line and for your company, for your investors. Maybe talk to us about some of those different principles that have helped to make you successful.
Yeah. I think from, and I wrote an article about, 10 ways we apply Wall Street principles to multifamily. So that may give some, just, I like to be, when I say something, I don't like to just put it out generically. I like to be pretty specific about it. And those would probably be a little bit too detailed for the podcast. But, I think just one thing that I constantly think about is I've done, thousands of commodity transactions in my career. And, I think of rents like trades. So what does that mean? It's rents are market driven, and just like commodities are market driven. And so you lock in a price and like you lock in rents, and then you could say, okay, well, was that rent higher or lower than the previous person that was renting there? Is the trend up or down? What are other people doing? Did they just bite right away? Should we increase rents? Do we have to adjust rents? So I feel that we try to keep a pulse on rents, almost like trade flows, so that we can pivot in our strategy. Do we need to offer concessions? Do we need to change something in the units to make them more palatable? Do we need to change our advertising and marketing? Because if you get rents correct, a lot of that covers over a lot of the other mistakes, assuming that you bought in a good area and so forth. But so that's one way that we're uber focused on that. And so then, again, kind of what I alluded to, just being very institutional, transparent, hands-on, and just Wall Street principles there as well.
Yeah, and that's fantastic. So being able to use that, and I'll sum it up, because that's really what you're talking about there is looking at some of the different key economic drivers, right? And specifically talking about revenue and how revenue can be derived from rents, and there are other different types of revenue that you can also create in the multifamily space. But to your other point, which is this is a pretty simple business. It doesn't mean it's an easy business, but it's really revenues are you able to derive, and then based on that, then you manage your operating expenses, and that drives your NOI or your net operating income, and then from there, well, that if your cap rates are depressing, that's a good thing for a seller, and maybe not such a good thing for a buyer. But it goes back to one of those principles I was mentioning before, and kind of the other three that I'd like for you to talk about specifically, where you talk about the key economic drivers. You also talk about kind of like what's the potential upside, what could go wrong, and then what's your gut on the sponsor. And maybe you could talk us through, because I love the simplicity of those kind of principles. But maybe there's something that are new, or maybe the going long family haven't really heard the other three, like what's the upside, what could go wrong, and then what's the gut on the sponsor.
Sure. Yeah. I think the sponsor one is, and I start that 25 questions every passive investor should ask with, 90% of your investment decision is, do you know, like, and trust the sponsor? And if you don't, that's like question number one. If you don't, just put this down and, put the prospectus down and just run away. And, this is a, rather unregulated space, and you just have to be careful. I mean, it's real money. It's not monopoly money. Some people treat it as such, but it's real dollars. And, that's so important. And because, do you trust them when nobody's looking with bank accounts? Do you trust them with large, $700,000-800,000 CapEx budgets? And, $4 million hit our bank account or so the day that we closed our transaction. And, fortunately, all our investors, I'm very proud to say we have repeat investors, people that have, really appreciated our very transparent monthly updates. So, that's one thing that's just super, super important. So spend time getting to know your sponsors. And frankly, if they don't answer, straightforward questions, and you feel like, I just think one gift that I've gotten from God is just a God-given sense of, just feeling people out, and I think just in a sales career, I've met tons of people. So it's like, do I think I'm going to get, are we going to do business together or not? Does this person like me or not? And, if you can feel out, do you trust this person? If you get a bad feeling, just there's so many opportunities out there, move on to the next person. Yeah. So I'd say that's one. You had mentioned two other things you wanted me to touch on. So apologize at this.
Yeah, no, yeah. It was just like, what's the upside and what could go wrong?
Okay. Yeah. So on the, what could go wrong, what I look for, and again, just being in a sales and trading environment, because markets, who would have thought, right, that before we entered 2020, that the pandemic was going to be as explosive as it was, and it was going to frankly shut down NBA games and travel. I mean, it was insane. I would have, if someone told me that in 2019, I'd been like, you're kidding. Yeah. And so, you have to figure out, we can't control everything, but we try to box in different risks, right? So whether that is interest rate risk, or whether that's, hey, could we overspend on CapEx and not get the required rent bump? How can we box that in? Well, the comps are sold out for all their upgrades. So that really helps us. And what we can do, have a plan A, plan B, in terms of a series of upgrades to test the market. And if we're in tune with rents, we can pivot in terms of how much we're spending. So, different things like that to box in different risks. as well as, insurance risks and other things. So I think that's one. And then on the upside, we tend to be pretty conservative. For instance, we've for some of our properties, we've gotten above, the property has proved that they can hit our pro forma rents, but sometimes we'll just back those down. Even though they've already hit those, we just back things down. Just give us operational flexibility. Our CapEx budget, we pad. For instance, some of our properties will be like, oh, the roofs need to be replaced. They don't need to be replaced now. It's probably, and we may not ever replace them. The lenders didn't require it, but now though we have, $25,000 for plumbing repairs and roof repairs and just cushion and padding so that, if something does go sideways, we have ample liquidity. Another thing that we'll do is we'll just pay all of our distributions out of operating cash flow and all of our CapEx as well, so that we just keep CapEx, $700,000-$800,000 amount in the bank, and just whatever the property is generating in this bank account, and we're just paying distributions and almost living like that saying that we live, we make however much, but we live on beans and rice type of thing. So we try that approach just to keep that discipline, because once you put that money in, you're like, oh, we have so much money, let's just spend here, and there. We just try to say, no, let's just live within these means and see if we can do it, and use this as a rainy day fund. So that's another strategy, again, just to box in the risks. And then on the upside, we always run exit cap rates against us. So whether that's 10 basis points or more a year, and even though we really feel that cap rates are going to stay flat or even compress some more, just given how much momentum is in the space. So that's super conservative. And each 25 basis points of cap rate probably has a 10 to 15% impact on total returns, roughly, for a deal. So if we're holding that against us or marking the books against us, and that is a way to just have that degree of conservatism. But that when you actually go to sell, there's a fair amount of upside there. So just some things that we do to navigate the upside and downside.
And I think those are great examples, and it goes back to your point as well. Like, just when your gut on any sponsor, and you're giving great examples, is that have your sponsor be able to explain things to you in a way that makes sense, and whether that means there's a massive upside or there are things that are being done to make sure that the downside is protected. Right? Sometimes people can ask questions, why is this so conservatively written? But then when you have something like the pandemic that happens, and you realize, okay, well, glad that it was underwritten in this particular way. It really can help you. But making sure that your sponsor can explain those things to you in a way that you understand are absolutely key. So thanks for taking a couple extra seconds to help us understand that. One of the things that I think would be interesting, just before we go into the going long final three, is maybe just come back to one thing that you were mentioning before, Ryan, which was your passive investing experience. And then I want you to remember that, and then also where you are today as you're leading sponsorship on specific syndications. And like, what were the things that you learned as a passive investor that are really serving you well today? You've maybe touched on a couple of them across the way, but I really want the Going Long family to understand how that previous experience as a passive investor is really helping you today in terms of best serving your passive investors.
Billy, great question. So, a number of things that we felt that reports, people would write like these autobiographies or just, theses on, each month. And all I want is a quick thumbs up, thumbs down on my passive investments. It's not a huge amount of my personal capital, but I just want to know, hey, is this thing going off the tracks or on? And frankly, I'd read some of the reports and I was like, I don't even know. And, just how things were laid out. It was just, again, it's, from a Wall Street perspective, it's always like executive summary, boom, boom, action items, really short, succinct, but it's powerful. And because people have spent a ton of time getting it that way, synthesizing the data to put it in a well-formed package. And I think other people will just have a data dump of stuff. And it's like, that's so not helpful to me. And so our monthly reports, we've gotten amazing feedback on those, just in terms of being transparent, being timely. We send things out monthly, or distributions are monthly. And I think of the 16 or so deals I'm in, only 2 of them, actually of the syndications, only 1 of them is paying monthly. Everybody else is quarterly. Our 2 deals and our soon to be 3rd deal will all be monthly. And for us, why we do that is it just, a few reasons. One, people like the visibility that they're getting something every month. They can hopefully count on it, hopefully it's stable. And two, on the quarterly side, 3 months, a lot happens. Like when I think about where I was in December, versus now, like so much has changed. Right. And it's like, they're like, oh, well, this distribution is for December through February. And I'm like, gosh, it feels like so long ago and you have no visibility. It's like so choppy. And that to me, I just don't like that. My investments in real estate are for, passive investments are for passive cash flow. And if you can't deliver that monthly, it doesn't really help me that much. So, so that's one thing. The other thing is K1s being on time. So those are what sponsors provide for year-end tax filing. And so, there's sponsors that frankly, I will not invest with again. Solely forget about the reports being horrible, but solely, and I don't like to talk ill about anybody, but, just being truthful here. The K1s have been habitually late. And for me, it's like K1s were supposed to be due March 15th. 37.5% of all of my passive investments, the K1s were late. So those people, it's like, sorry guys, no interest in investing with you because, frankly, I'm looking at about, $100,000-$200,000 refund again this year. And it's all held up because of 2 guys right now. And it's like, that's crazy. Ours went out March, exactly March 14th, I think it was. And, that's something that having invested in so many passive deals, I know what it's like to sit there, be waiting for a refund and be chasing someone. And it's like, that person's on to 5 other deals. And so, from a perspective of, do they really care about this deal? One syndicator, frankly, I won't invest with him again because he's gone on, done 4 other deals. The deal that he's in with us, that the reports are horrible. And fortunately I invested a very small amount and the reports are horrible. And, the distributions have been frankly non-existent and the K1s are late. So it's like, 3 X's right there. I'm out. So, again, it's knowing your sponsors, people will always be nice. Like, who is it going to tell you I guess for your investors, or your listeners, who is going to tell you that, hey, this is a bad deal, invest in it? Like nobody, right? So that's what's so tough about this space is figuring out what are they not telling me and what do I need to figure out? And that's a huge challenge. And that as well, when you ask them straightforward questions about whether property taxes or insurance, and they can't give you a straight answer, it tells me they're not on top of it. And to me, that's just not acceptable. And so that's why I've been uber picky, going from I needed to invest passively, diversify across a lot of people, had a very short window to do it, where I couldn't be very selective because there's only so many deals that are going to come across your desk, to now being like super, super selective because I know what we put into our deals and I know that other people aren't doing that. Yeah. That's not just me saying, that's just fact.
Yeah. And I guess the thing to take away from this is as you have your investing as a passive investor, those experiences that can be influenced in the way that you are doing things differently in your case as a lead, as well as a lot of what we're hearing is, I'm sure, has a lot to do with your background, your Wall Street experience, and also being able to apply those lessons and with the goal of always making the best possible experience for your limited partners or your passive investors. So I appreciate you sharing that. And you know what, Ryan, it's that time where we got to get into the lightning round of the Going Long Final 3. So we're going to get some really quick responses from you and be able to wrap things up because I want people to know how they can get in touch with you best. So as you know, the Going Long Final 3, I never ask anybody unless you tell me that you're ready for me to ask you. So are you ready?
I'm ready. Let's do it.
All right. I figured you would be. So perfect. So we started on your side of the pond, and I like to bring it back this way to Europe, where I'm living. So what is your favorite European city, either that you visited or is still on your bucket list to visit?
Yeah, I was thinking about my response to this, and frankly, I would just say my favorite country, and that would be France. Because anywhere in France, I haven't seen a place that I don't like, and I think it's because for me, it's about the language. I speak the language. Billy and I were talking French before this started, and then to the food. So like it's one of those weird things in France where I've never gone into a patisserie and had bad pastries or, a bad tarte aux framboises. It just doesn't exist. Yeah. So, for me, those two things, and that's kind of universal in France. Like you're going to hear the French language and you're going to have good food. So beautiful country, amazing place.
All right, perfect. I'll let you get away with the country instead of the city because I also live there and I share that comment. And I think even at a gas station, you can get wonderful croissants.
Yeah,
exactly. So perfect. So next question. All of the successful people that I know have only made one mistake in their entire career. And that's what, I get that wrong every time. So you've probably made lots and lots of mistakes, right? Or learning experiences or however you want to look at it, right? But if you could just share like one really quick lesson that you would pass forward to the entire Going Long family, what would that one lesson be?
I think I alluded to the lesson for me from a career perspective is that when things were going pear-shaped in the financial crisis, I was offered a job, at a deeper into the oil and gas space and kind of away from a Wall Street firm. And, frankly, I would say I panicked because, Wall Street was just cratering and I was like, there's no stability. The world's coming to an end. And, I think there was a level of not having experience. I mean, that was kind of a pretty crazy catastrophic event, if you will. But, and I ended up going to this one firm. And then, immediately like day 2, I was like, this was not the right decision. And I called my previous employer. It was a very humiliating, humble discussion. But I said, hey, I made the wrong decision. And he said, hey, we're going to have to wait some time, but we'd love for you to come back. And fortunately, 9 months went by and I came back and then, things took off from there. But, for me, that was something that is one of those lessons that I always tell my kids is that, sometimes even it's a white knuckle ride, you got to hang on. And, that's why when I was saying during the pandemic, and I remember selling my stocks during that period, I was like, all my foreign, just, not everything, but a lot, just saying like, hey, it's not going to get better. It's horrible. And, I hit my limits of what the pain I could take. And, frankly, then everything rebounded. And I just felt like, wow, that's markets for you. Just when everyone's thinking one thing, you need to just say, guys, it's not the end of the world. And I remember my business partner, me being like, oh man, like COVID is going to change things permanently. And, I think a lot of people thought that, but as we see, like you go out to restaurants, things are full. In Houston, I went to one place on Friday. It was packed. There was not a place you could park. So it's like people don't mind gathering again, and people are excited about it. And so, my view is that, COVID has changed some things, but I think we're going to get back probably to more normal, quicker. And I think more normal than we thought during the depths of the pandemic. So that's just one big lesson that I've learned, and that, it just applies through, also even mini crises that people have in life. It's like, hey, this too shall pass.
Yeah, that everything's a cycle. So I appreciate that. And then the last one, going into it, always like to feed our brains here. So what one book would you recommend to the Going Long family?
Oh man. Honestly, and I'll be candid, this is not going to be a great answer, probably going to be the worst answer that, people said. I have frankly been so buried with our properties and our assets. I need to take a strategic, what do they call it? Sabbatical and sit down and read some books. I've started a few things, but, one friend did give me a Darren Hardy, goal setting type book. And I started pretty heavy and hard this year. And then, got pulled away into some deals. So it's not a great answer. And, if any of your listeners if they're reaching out, I'd love to hear what their recommendations are, because that's a shortcoming of mine right now.
All right. So here we go. We'll come up with one for you. I've got a couple that I think would work well, because you were talking about earlier the decision that you made in the midst. And I mentioned that book Halftime, and that was one. Sometimes when you just have that moment in time, it's a moment of reflection, and you can do a lot of really, really awesome things after that. So listen, man. So we've talked about a lot of different things, and you really helped us understand from the background in Wall Street and being able to have that moment in time when you reflected and thought, well, at that Chuck E. Cheese party, well, I need to do something differently. You did it passively. You then evolved into co-sponsor, and then have now taken over leadership in terms of sponsoring deals. And you've got obviously a very clear focus in a specific area. And I know that there are so many people you've talked about earlier, like ways that people can get in touch with you, but help us understand, what is the best way for the Going Long family to find out more about what it is that you're doing, Ryan?
Yeah, no, thank you. And Billy, thanks again for having me. This has been great. I really appreciate your questions, and it's been fantastic. And lifechangingcapital.com is the best place to find me. We have spent a ton of time, curating resources. We have the 25 questions every passive investor should ask. We have other articles that we've written about our takeover process. And again, we try to be very transparent on how our deals are doing and what we're doing that's differentiated. So a ton of resources. You can book some time with me. And if you'd like to be added to our investor database, there's also a link for that. So all of that is there. And if there's any questions that you have, feel free to reach out.
All right, cool. Lifechangingcapital.com. Head over there, Going Long Family, filling out lots of information and things that Ryan and his team are doing. So fantastic. So listen, Ryan, I just want to thank you very much for investing your time with me and the entire Going Long family. It's been very educational. Thank you very much.
Billy, it's been a pleasure. Really, really nice to meet you, and enjoyed hearing about your background. And thanks for reaching out and inviting me to be on the podcast.
All right, fantastic, perfect. So just a couple quick words for the Going Long family. Listen, Ryan left so much great information, great things for you to think about. You have an opportunity today to be the positive impact on someone else. So why don't you take just a couple seconds and share today's episode with at least 2 to 3 other people, and be that person that can positively impact someone else's life. Also, take a chance, or just take a couple seconds. Also, leave your honest review. Like, what did you like about today's conversation? What would you have loved to hear about? You know that I go through every single one of those reviews. It's something that I think is really, really important to continue to make this conversation, or these conversations in this podcast, exactly what you're investing your time in with me here twice a week. And you know what? Until the very next conversation, I'll be really, really looking forward to welcoming you back. But in the meantime, I want you to go out, make it a great day, and thank you very much.
Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long-distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.